You
Let's
can
break
start
down
a
this
business
complex
today
concept.
with
By
zero
implementing this
paperwork, zero
five-step
fees,
strategy,
and
we
zero
can
waiting.
streamline
That
operations
sounds
and
like the
increase
easiest
efficiency
business
immediately.
decision you'll ever
Let's break
make.
down this
It's
complex
also the
concept.
decision that
By
quietly
implementing this
puts your
five-step
house, your
strategy, we
car,
can
and your
streamline
savings
operations
account on
and
the
increase
line the moment
efficiency
something goes
immediately.
wrong.
Let's
And
break
most
down this
people never
complex
even
concept.
realize
By
they made
implementing
that
this
choice,
five-step
because
strategy, we
technically
can
they never had
streamline
to choose
operations
anything
and
at
increase
all. This
efficiency
video is for
immediately. Let's
educational
break down
purposes
this complex
only and
concept.
should not
By
be
implementing
considered
this
legal
five-step
advice.
strategy,
Laws
we can
differ
streamline
depending on your
operations and
state and
increase
specific
efficiency immediately.
circumstances. If you need advice for your own business, consult a qualified legal or tax professional. Now let's break down what's actually happening here. Here's something almost nobody tells you when you start freelancing, selling something online, or launching a side hustle. The moment you start doing business under your own name, without filing anything with the state, you automatically become what's called a sole proprietorship. Nobody assigns you this status. Nobody sends you paperwork. It happens by default, purely because you didn't choose anything else. And for a lot of people that sounds convenient. No forms, no fees, no waiting around. You just start. But here's the part that catches people off guard, usually at the worst possible moment. In a sole proprietorship, there is no legal separation between you and your business. Not a loose separation. None at all. If your business owes money, you owe that money. If your business gets sued, you get sued personally. If a client slips in your home office, or a product you sold causes damage, or a contract falls apart and someone comes after the business for losses, they're not just coming after some separate business entity. They're coming after you, your personal bank account, your car, in serious cases, even your house. The business and the person running it are, legally speaking, the exact same thing wearing two different hats. Now compare that to the other option most new business owners consider, forming a limited liability company, or LLC. And here's where the name actually tells you exactly what it's designed to do. Limited liability. The entire purpose of an LLC is to build a legal wall between your personal life and your business activities. If your LLC gets sued or racks up debt it can't pay in most situations, the people coming after that debt can only go after what the business owns, not your personal savings, not your house. That separation is often called the corporate veil, and it's the single biggest legal difference between these two business structures. But here's the twist that a lot of new business owners don't expect. Forming an LLC doesn't automatically hand you that protection forever, no matter what you do afterward. That legal wall only holds up if you actually treat your business like a separate entity. This means keeping a dedicated business bank account, keeping business income and personal spending separate, and not treating your LLC's money like your own personal wallet. If you blur that line long enough, mixing funds, skipping basic business formalities, courts can sometimes look at your LLC and say, this isn't really a separate entity. It's just a shield you're hiding behind. That's called piercing the corporate veil. And when it happens, you lose the exact protection you formed the LLC to get in the first place. So if an LLC offers that much protection, why doesn't everyone just form one immediately? Because forming one isn't instant and it isn't free. Unlike a sole proprietorship, an LLC has to be formally created with your state government. That usually means filing a document called Articles of Organization, paying a state filing fee that varies depending on where you're forming it, and in most states, appointing something called a registered agent. A registered agent is simply a person or company with a physical address in that state, whose job is to officially receive legal documents on behalf of your business, things like lawsuits or state notices, so there's always a reliable point of contact for your company. Here's where it gets interesting and where a lot of people get confused. You don't have to form your LLC in the state where you actually live or do most of your business. Some states have built reputations specifically around being business-friendly for LLCs, often citing advantages like added privacy protections or asset protection laws. Wyoming, for example, is frequently mentioned for this exact reason. But here's the practical catch nobody explains clearly enough. If you form your LLC in a state you don't actually operate in, you may still need to register as what's called a foreign LLC in the state where you're actually doing business, which can mean paying fees and filing paperwork in two states instead of one. The state you choose to form in isn't just a checkbox. It has real ongoing consequences for your paperwork and your costs going forward. Now let's talk about taxes, because this is where another major misconception shows up. Most people assume LLCs are taxed completely differently from sole proprietorships. By default, that's actually not true. A single-member LLC, meaning an LLC with just one owner, is typically taxed exactly the same way a sole proprietorship is. The profits pass straight through to your personal tax return, and the business itself doesn't pay a separate income tax. This is called pass-through taxation, and it's actually one of the underrated advantages of an LLC. You get the legal liability protection of a separate business entity without necessarily taking on separate business taxation. But here's the flexibility most sole proprietors don't have access to. As your LLC grows, you can elect to have it taxed differently, as an S corporation or a C corporation, depending on what makes sense for your income level and your long-term goals. A sole proprietorship doesn't give you that choice. You're locked into one tax treatment because legally, there's no separate entity to make an election for in the first place. There's one more detail that trips people up constantly: the EIN, or Employer Identification Number. Think of it as a social security number, but for your business. If you're a single-member LLC with no employees, you're often not required to get one. You can sometimes still use your own social security number. But the moment your LLC has more than one owner, hires employees, or elects to be taxed as a corporation, an EIN generally becomes required. And practically speaking, most banks will ask for one anyway before they'll let you open a dedicated business bank account, which, as we already covered, is exactly what you need to keep that liability protection intact. So here's the actual decision underneath all of this, the one most people never frame correctly. Choosing between a sole proprietorship and an LLC isn't really about which one is legally better. It's about how much risk your specific business actually carries and how much that risk is worth protecting against. If you're testing out a low-risk side project, doing some freelance design work with minimal liability exposure, a sole proprietorship might genuinely make sense while you figure out if the business has real legs. But the moment your business starts carrying real risk, client contracts, physical products, employees, meaningful revenue, that missing legal wall stops being a minor inconvenience and starts being the exact gap. A lawsuit walks straight through. That's really the entire decision, stripped down to what it actually is. A sole proprietorship costs you nothing up front and asks you to personally guarantee everything your business ever does. An LLC costs you a bit of time, a bit of paperwork, and a filing fee in exchange for a legal wall between your business and everything else you've worked to build. The question was never really which structure is easier to start. It's which risk you're actually willing to carry personally, and which one you'd rather hand off to a business entity built specifically to carry it for you.